Welcome back to the course Introduction to Commercial Banking and FinTech. We are now in session 43 and we are going to discuss an important topic I think a lot of you must be knowing about, and those who are doing it for the first time, you may find it interesting because we are going to discuss some of the measures that you may not have known earlier, or it is not the mainstream, but these measures are being used in the textbook and also for banking research, especially those who work in the area of banking risk and management. So systemic risk becomes a natural choice, and a lot of time we find that especially in the research domain, people use these indicators to measure. But in a very comprehensive exercise, we are going to understand different dynamics of systemic risk in the case of the commercial banking, and we will also try to shed light on the Indian setup, that how India's RBI manages that. We will start with the basic structure of Basel III, different buffers that we were discussing in the last session. So last three sessions were mostly based on the Basel III framework and how it has been implemented in India with the global exposure understanding, and how those regulations have helped shape the banking sector regulation in India as well as at the global level. Now, coming to systemic risk as such measure, because it is dealing with the overall system, but it could be because of the failure of one banking institution. So we'll try to see some of the measures related to that. So let's start. We are going to have the understanding about, so apart from these references, so Hull book is a good reference, Saunders you can refer, Mishkin is a good choice to understand. But apart from this, we have also referred research papers from journals because some of the topics are not covered in the textbooks. So wherever we are referring those, we are also citing those papers, and not in detail because this slide, but I will highlight the journals and the author's name wherever applicable, so that you can search through the author's name and find out if you want to read more about it. So this particular lecture is going to be slightly advanced as compared to what we conventionally read about the commercial banking or the courses offered at the university or the college level, which is related with the money and banking. So as we were discussing in the last session, that Basel III talks about capital buffers, which means that a counter cyclical stand Basel III promises, and it also tries to give some kind of cushioning to the banking sector. So what we are adding in Basel III is the capital buffer that we are going to see here. So it is all about the capital buffer we are seeing, and this buffer has different components. One, we call it as the capital conservation buffer. Under that, we try to get into some of the additional capital requirement apart from the minimum capital requirement that we have. So CAR, capital adequacy ratio, plus the capital buffers are going to be part of. Then there are counter cyclical buffers, which means that if the banking sector faces adverse situation because of the slowdown or something, so they must have the extra cash to counter. So this is called counter cyclical capital buffers. Then there is also, if the bank is systemically important bank ranked by central bank based on their size, and it feels that if this particular bank is going to come into trouble, then it may create a systemic risk in the economy. So for that, there is something called systemically important buffer. Let's go one by one and understand that how it looks like. So let's go by the capital conservation buffer. I think we touched upon this when we were discussing the Basel III, when we started discussing. So capital buffer is an additional common equity tier 1 capital requirement above the minimum regulatory capital, which means that the capital conservation buffer as of now, it is 2.5% of the total risk weighted asset, and this is where it becomes important. For example, if the risk weighted asset is 10,000 crore, so 2.5% of 10,000 crore, which is 250 crore, is going to be the capital conservation buffer, which means that it will be bank will have to keep 250 crore extra apart above common equity tier 1 capital. So you can think about this is some kind of extra cushioning that Basel III promises. Second interesting component is again about the counter cyclical capital buffer, which deals with different kind of economic cycle conditions. For example, here we have 0 to 2.5% of the risk weighted assets. So it basically talks about, so counter cyclical capital buffer, there are for or against. Some argue that it will create a lot of pressure on the banks to keep this capital extra, but there are people who argue that this is good for the banking. So it builds additional capital buffers during the expansion period, and also it helps protect the bank from the bank run during the downturn. So for example, if the risk weighted asset is 20,000 crore based on the different weightage pattern that we know already, if it is 1%, so 1% of 20,000 bank will have to keep as a counter cyclical buffer, and this is where it makes the Basel III unique as compared to Basel I and Basel II. Then the next one comes after global financial crisis 2007-8, when we saw that global banking system went for a major transformation. So then across globe there was emphasis on identifying the domestically systemically important banks. What are these banks? Based on their size, our central bank publishes the ranking. For example, in India you have the State Bank of India, HDFC, and then here you have Axis Bank also. So Axis Bank also we count that as an DSIPs, we call that DSIPs. So basically too big to fail, to avoid the situation of too big to fail, which is a requirement, which is one of the dimensions of the systemic risk, and too big to fail central bank has to avoid, because it will have the spread of risk across the banking system. So this is what. So RWA is 30,000 crore. If 1% we are going to keep as a systemically important bank buffer, then it is 300 crore. So you can think about, if I have to think about having this setup, for example, if I go on, for example, if I have the risk weighted assets of 10,000 crore, and if minimum capital requirement is 9% that we have seen in case of India, and capital conservation buffer is 2.5%, and systemically important bank buffer is 1%. So how much will be the capital requirement? So you can see 9% of the minimum capital requirement, the CAR that bank has to maintain. So 9% plus 2.5%, so 2.5% is this, plus 1%, so it means that we are talking about 12.5%. So required capital is going to be how much? So 12.5% of 10,000 crore, which means that 1250 crore rupees banks will have to keep. And how much is the additional? So 3.5% is because of the Basel III. So Basel III is contributing in the buffer list. So you can say Basel III is contributing 3.5%, because to avoid the Lehman kind of situation, and especially in case of developing countries where the regulations are not that strict and there is a chance of high rent seeking between the regulators and the firms, then it may happen that bank and firms may have some kind of rent seeking exercise. As a result, it may create a trouble. So there are studies talking about politically connected firms, politically connected banks, and how government owned banks go for moral hazard. So there are a whole lot of bunch of issues that we discuss. So capital buffer significantly strengthen bank resilience, that we are using the term, and another important term is the financial stability, which means that when we are going for Basel III, so in Basel III the capital conservation buffer and systemically important bank buffer play a very important role, right? Now let's come back to another topic. So we covered Basel III. So with this we are able to conclude with all those indicators that we discussed. Those indicators will be coming back again as we are going to see different systemic risk measures. Let's talk about macroprudential risk. So what do you mean by macroprudential risk, and how do we define the macroprudential regulation to control the spread of the macroprudential risk? So it focuses on preserving the stability of the banking financial system as a whole rather than individual institution, which means that overall umbrella kind of so financial stability board that we have, financial stability regulatory board. Every country after 2007-8 global financial crisis has come up with this. There are two types of of potential risk regulations. One is the micro potential, another we have the macro potential. In macro potential, we talk about the regulations related to individual bank or institution. So at the entity level, we are mentioning. Macro potential means overall, entire. So systemic risk, if you want to measure, so it is basically talk about risk of disruption in the financial system, and it could be because of the excessive leverage that we have already discussed. We will be discussing one more kind of leverage, which is balance sheet based here in this particular session, and second is about the asset bubble that we talk about, and third is the financial interconnectedness that we see. So this is where it is very important to note. So I hope it is clear that macro potential risk basically talks about the aggregate risk, the macro level risk, and it also takes into consideration the micro level at entity level or institution level risk, how we can minimize. Now, if you in India and globally, a central bank is given the task to monitor the systemic risk situation, and they always come up with, after 2000 global financial 7 global financial crisis, we have seen that each and every central bank is publishing the financial stability report. Why it is important? Because we have, if the central bank is reducing the rate of interest, so this may create excessive credit growth, and that growth may have the extraordinary the bubble formation or economic expansion. So asset price bubbles can create, so that we saw in the case of US during Greenspan era, how they had pumped the money, and that was later busted in the form of the global financial crisis, in the form of subprime borrowers and lenders, high leverage. It could be, and it could be also because when government comes with any kind of infrastructure investment that we saw in India mid 2000, that how it created the twin balance sheet situation. So it could be. Interconnectedness and contagion are some of the important banking research based topics that people explore. So interconnectedness means either the systemic risk could arise because the institutions are too connected to fail or too big to fail, right? So too big to fail, we saw that the domestic systemically important bank, but too connected to fail is a topic that banking research has started examining, and there are different types of models to measure. But interconnectedness basically says that how much is the borrowing and lending taking place between the banking institution. Contagion, there are two terms for contagion. Contagion is the term that we say about the increase in correlation during the crisis. When a crisis starts, during that time, if we see increase in correlation between the institution which is in deep trouble with the rest of the institution, then we say that because of this, so institutions were trapped, and they were also experiencing low or you can say fall in the prices, or may are having the same kind of risk. Then here you have the interdependence, or the term you can say the integration. So integration does not take into account explicitly the crisis period. So contagion definition is basically when you are seeing the measurement of the correlation during the crisis period. In India, macroprudential regulations are mostly linked with the Reserve Bank of India. Then there are Financial Stability and Development Council, FSDC. It also helps. So time to time the FSDC meets and try to see that what is this the risk level in the at aggregated level across institutions, and if they find that some institutions are having some trouble, so they will also try to look into. So it basically tells you to reduce the crisis probability and strengthen the financial system resilience. So this is what it implies. Now the second part is that, so we have already discussed these things, that how it is. So macroprudential could be like when the FSDC is going to put a check on the counter-cyclical capital buffer. Then here we have the capital surcharge for systemically important banks. So DSIPs, how they are so classified as DSIPs. So it means that if there is a risk arising in these banks, then central bank will have to give a huge amount of money. So this is what. Another is the loan to value limit, that you can put a limit on the individuals right? So when we're discussing the monetary policy transmission, so at that time we had the headroom kind of scenario, which means that you put a cap on the borrowing of the individual. For example, if earning 1 lakh rupees, the central bank may instruct the banks that you cannot give a loan which will have the repayment amount of more than half of the income of this individual, because this individual has to survive, has to spend on his own consumption and others. So in that way, so house price is 1 crore, maximum loan allowed is 75 lakh. So on the total amount also sometimes central bank puts a check. So these are the tools through which central bank tries to minimize the systemic risk. There is another term that we often use, and if you read the financial stability report of the RBI, so there we find that the stress testing is discussed deeply, and it is a regular exercise for the central bank to conduct stress testing on all the institutions and try to see that with different scenarios how is the overall outlook of the banking. So the question that stress testing answers is that, can bank survive severe economic shock? So they will be putting macroeconomic condition, bank specific condition. If there is any regulatory condition, like for example counter cyclical buffer, then you have the capital requirement buffers, all those things if you want, or if you want to target the non-performing assets. So they include basically recessionary trend, that what happens if the economy is going to experience a fall in output, interest rate increase, when the borrowing cost is going to go up, what is going to happen? A stock market crash, when the price of the banking stock is going to come down, then what will be the impact on this? That will be measuring explicitly with the distance to default. It is going to come in a moment. Then increase in NPAs, right? So basically a capital after shock, which means that how much it has the initial capital and how much is lost, and that basically talks about the vulnerability of the bank. And stress testing after Basel II, it has become mandatory, and if you want in India, you can read the financial stability report, though they may not be giving you the exact methodology how they are conducting, but they discuss in detail about the stress testing scenarios and provide the overall picture. So I tried to, though stress testing is a very complex topic and it may not be possible in this particular course to go through everything, but I have tried to give a pilot kind of understanding about the stress testing in the case of banking, that how one can conduct. So basically it evaluates whether banks have sufficient capital to withstand adverse economic shocks, right? So for example, if the initial balance sheet, the total loan portfolio is 10,000 crore and bank capital is 1200 crore, right? So the adequacy ratio is of course 12%, right? So it looking like the bank is having sufficient capital to counter any immediate shock. But if you have a shock coming like for this, in this case, that suppose increase in loan stress. So for example, suppose 8% of loans become non-performing and it results in losses. So here loss would be 8% of 10,000, which is 800. So you can think about, so new capital will be how much? It will be 800 adjusted of losses. So you will have the 4%. Now you are seeing that CAR, you are not able to meet the 9%, right? It is supposed to be 9% and it is less than 9%, which means that bank will require additional capital, or they may have to go for borrowing or do some kind of recapitalization request with the central bank. And this is where it matters that how stress testing is important. And in this case, we saw that as the bank experienced the higher, you can think about the waterfall kind of situation that we discussed in the last session, that which capital will be deployed. So you can think about the common equity tier 1, additional tier 1 that we have. So CET1 plus AT1, which is equivalent to tier 1 capital. So it will be deployed, then tier 2 and so forth. But here it is simple that when they are going to experience this shock, then we will see that the CAR ratio is coming down below the threshold level, and this creates the trouble. So if I have to go for stepwise understanding the stress testing, so this we do it. Stress testing, it evaluates the bank's resilience under the adverse macroeconomic scenario. Suppose GDP declines by 5%. So suppose in this year 2026, if the government says that they are going to have the GDP of 7.5%, But in stress testing, we put a scenario that what happens if the government does not achieve this GDP growth, then what is going to be the likelihood. So interest rate increase by 3 percentage basis point. So we are considering the extreme situations. Corporate defaults increase due to economic slowdown. Their sales have come down. So because of that, they are not able to pay. Their interest coverage ratio has come down, and this may create a trouble, right? So this is what here. So these are the expected situations. I hope we are dealing with 43 lecture for the 43rd session. So I hope these things you can connect easily. So I am skipping it. Estimate credit losses. So for example, if we are going for the total loan exposure of 5,000 crore, for example, the probability default that we calculate through all the logistic regression that we have discussed already in the Basel II, after standardized approach, we have something called the internal IRB method. So if you have the internal rating based approach, based on that I calculated 10% probability based on the KYC data, and loss given default is 50%. So then how much will be the credit loss? So then we know that we have already done this, the expected loss that we calculated in the last to last. So 0.10 into 0.50 into 5,000. So it is coming out to be 250 crore. If the bank has sufficient CET1, it is not a big challenge. But if the bank does not have 250 crore, then it is a challenge, right? So this is where the losses that we get into, right? So this is what we get. Then we measure the capital impact. How much we have to think about adding the capital impact on this. So for that, suppose the initial capital is 800 crore. The new capital after stress, because 250 crore has to be adjusted. So it is just 550 crore. Now you can see it reduces the bank capital, and is it linked with the losses, then it will have impact on the CET1 and all other factors, and this is where it plays a very important role. So this is what we try to define, that when we are measuring the losses of the bank through bank capital and how the bank capital does play an important role. So this is where we are finding. Now the last is steps 4 and 5. You have to calculate if I have seen 250 crore decline out of 800 crore of total capital, and suppose if the risk weighted assets is 5,000 crore given the composition of the risk weighted asset that the bank has. So the new capital adequacy ratio, it is going to be 11%, which means that it is meeting the requirement. So but if you compare with the original value that we got for the CAR, it appeared to be 16%, but because of the 250 crore loss, we are saying that has come down to 11%, and this is where the challenge comes in. If the regulatory requirement is that you should meet 12% of the target, then bank will have to seek extra funds, and they will have to get into some kind of recapitalization measure. So which means that with these scenarios, you can see that we are not just targeting the banking system, but we are also targeting all the institutions and all the major indicators, including the regulatory capital, and also we can also add the scenario of the leverage that we discussed in Basel III, that tier 1 capital or CET1 upon the total exposure, so that we can also include in a stress scenario. So stress scenario does not mean that you are considering this. You can consider any number of risk factor that you think of and that you can always try to get. We are now getting into one of the important topics that we are going to discuss, which is about how we can understand that whether the risk is spreading evenly or unevenly. Will there be a set of indicators to measure the risk, the likely risk on the banking sector? You have something called early warning indicators, right? So here we have early warning indicators mentions how do you detect the problem before banking failure. So this is before bank run case. So key indicators include the rapid credit growth. Then here we have the rising NPAs, declining capital ratios, falling profitability, and liquidity shortage. All these indicators have the ability to give you some kind of early warning signal, and it also helps you understand that whether it is showing increase or decrease. Now here, if I have to get into concrete indicators that give us the idea, there are a lot of studies talking about different types of indicator, but I have only use those indicators which are having full proof understanding and they have been given sufficient emphasis in the banking sector research. For example, capital adequacy ratio. We know that if the capital adequacy ratio, for example, last week the bank has the capital adequacy ratio of 15%, but now within a week, because of the structural shock, it has come down to 9%, then it creates a trouble for the bank. Gross non-performing asset, if it increases, then you have the likelihood of having more assets getting impaired, and this creates the trouble of credit risk. Then here we have the liquidity coverage ratio declining, which is LCR. We discussed in Basel III, it is part of the Basel III, it measures the short term, right. So 30 days you can think about. So here we have the high quality liquid assets, so HQLA upon, so we discussed in Basel III, right. So this is what we call it as the HQLA upon the 30 days also, whether you have the stable fund, how much you are receiving and how much you are having the outflow. If it is and we mentioned that LCR, if it is less than 100%, right, if it is less than 100%, then it means that you don't your liquidity risk is higher. If it is greater than 100%, then it means that you are maintaining the stable liquidity. Second is the return on asset. Return on asset is again the net income based variable, and it shows that how much, if the ROA, return on asset, is declining, then we can see that it is having the impact on the overall the performance of the bank. So all these indicators are important and we try to capture. Last but the least that we want to discuss is the market based early warning indicators, which is about the how we can measure the so for example, if I am just the layman and I have the deposit in the bank and I don't have any idea, how do I derive the information, or how can I get the information to capture the risk spillover? So first thing is the bank stock prices. Falling equity prices indicate declining investor confidence, reflect expectations of lower probability and higher insolvency risk. Bond yields and the credit spreads, that how much you have. So if the banks are having very awkward kind of bond yield, it means that if you have a interest rate rising, so the bond prices are falling but the yield is increasing. So this is also one of the signals that how you are seeing investor demand higher compensation for risk, if that is the case. Credit default swap, which is again the market based indicator, and if it gives you the signal that if it is increasing, then it is having or if the prices are falling, then it is also a good indicator. But for the layman, the bond yield and credit spread may not be having the credit spread, basically a little bit different between long term bond and short term, and bond yield and credit spreads may not be giving you the exact idea, but credit default swap gives you the idea. But in India, credit default swaps are not that much popular. In US and other countries they are, but bank stock prices are important, and this is where I find that we find a lot of synchronicity with the and majority of the banking risk in India triggers through the banking banks stock prices, and it has been one of the important factors. So I hope, just to give you the summary what we covered in this session. So we covered with the Basel III, the capital buffers, then we went into different types of systemic risk measures and we tried to see with different scenarios that how it helps. Then we went into the early warning signal, that how it can be measured, and then we are now discussing the market based early warning signal. So now we will start the next session from here and we will take it forward. I hope you are liking the course, enjoying it. You can also get back to us for any query. So with this, I am stopping it here. Thank you so much. I really appreciate your attention.